Hey there, and welcome back. Today, we are unpacking an absolutely incredible framework created by Same Herakli, who is an absolute expert in internal auditing, governance, risk management, and internal controls. If you're a focused learner looking to truly master the mechanics of financial integrity, well, you are in exactly the right place. We're diving deep into day 28 of this framework, the Accounts Payable Audit Masterclass.
So here is our roadmap for this explainer. 1. Objectives of AP audits. 2. Key risks and controls. 3. The procure-to-pay process. 4. Audit procedures and focus. 5. Transaction example and red flags. And 6. Impact and key takeaways. Let's get right into it.
Before we get into the weeds, let's establish our baseline. Accounts Payable, or AP, amounts the company owes suppliers for goods or services on credit. And an AP audit evaluates whether liabilities are recorded accurately, authorized properly, and paid on time to ensure compliance, avoid penalties, and safeguard financial integrity. Now that last part, safeguarding financial integrity, that's the absolute core mission of an auditor. We are here to protect the company.
Okay, let's start with our first major section. 1. Objectives of AP audits.
What are we actually trying to achieve here? Well, we need to ensure liabilities are recorded accurately and completely. We must verify goods or services are received before recording liability. Ensure invoices are valid, accurate, and authorized. Ensure payments are made to valid vendors only. Ensure compliance with policies, contracts, and payment terms. And ultimately prevent fraud, errors, duplicate payments, and losses. To put that into perspective, imagine your department orders, say, 50 new office laptops. Our objective as auditors is to ensure we don't just blindly pay a piece of paper. We literally verify those laptops have arrived physically on site before we ever record the liability and release the company's funds.
Moving right along, let's look at the antagonists of our audit and the weapons we use against them. 2. Key risks, and 3. Key controls.
First, 2. Key risks. Listen closely, because these are the things that can devastate an organization if they aren't caught. Liability recorded for goods or services not received, duplicate or fraudulent invoices, unauthorized or invalid payments, incorrect invoice amounts or coding, late payments leading to penalties and loss of discounts, vendor fraud or kickbacks, and, of course, poor segregation of duties. These are absolute organizational killers.
So how do we fight back? 3. Key controls. We rely on vendor setup with proper approval. Purchase order, or PO, authorization. Goods received note, or GRN, verification. The three-way match, which is PO, GRN, and invoice. Invoice verification and approval. Payment run review and approval. Timely payment as per terms. Vendor statement reconciliation, and proper segregation of duties. Now, the real star of the show here is that three-way match. Going back to our office laptop scenario, this control ensures that the purchase order for 50 laptops matches the goods received note showing 50 laptops actually arrived, which then perfectly matches the invoice for 50 laptops. It's essentially an impenetrable shield against fraud.
So how does all of this actually flow in the real world? Let's map out the life cycle of a purchase. 4. Accounts payable process. Example, also known as procure-to-pay.
It starts simply enough. Step 1. Purchase requisition. This is where a department raises a request for goods or services. Step 2. Purchase order, or PO. The PO is created and sent to the vendor. Step 3. Goods receipt, or GRN. The goods or services are received and the GRN is prepared. Step 4. Invoice receipt. The vendor invoice is received.
Then we get to the critical phase. Step 5. Three-way match. The PO, GRN, and invoice are matched. Step 6. Invoice approval. The invoice is verified and approved for payment. Step 7. Payment processing. Payment is scheduled and processed as per terms. And finally, Step 8. Payment made. The payment is released to the vendor. I really want to highlight Step 5 again. That three-way match is your definitive control point. It's the gatekeeper before a single dime ever leaves the bank.
All right, now we shift gears into the auditor's battle strategy. 5. Audit procedures, and 6. Areas to focus.
Under 5, audit procedures, we meticulously execute the following. Understand AP process and key controls. Review vendor master data and changes. Test new vendor setup and approvals. Verify GRN and invoice date. Perform three-way match testing and check invoice accuracy and validity. Testing those new vendor setups is absolutely crucial. Why? Because it stops shell company fraud dead in its tracks. You don't want a bad actor creating a fake vendor just to funnel cash out the back door, right?
Continuing with our procedures, review approvals for invoices and payments, test payment run and release process, review aging report and follow up on overdue payments, perform vendor statement reconciliation, review returns, debit/credit notes, and test segregation of duties in AP process. Remember, reviewing that aging report isn't just busy work. It actively prevents late penalties and maintains good vendor relations, which keeps the supply chain running smoothly.
Now, 6 areas to focus. What are we zeroing in on? Accuracy and completeness of liabilities, validity and authenticity of invoices, timeliness of payments and discounts availed, proper classification and accounting, compliance with payment terms, duplicate payments or overpayments, unrecorded credit notes or returns, vendor master maintenance, segregation of duties, and adequate disclosures in financial statements. Catching a duplicate payment during this focus phase, that's an auditor's bread and butter. It shows immediate, undeniable value by putting cash right back into the business.
Let's move to the practical application phase. 7. Example, AP transaction, and 8. Common red flags.
7. Example AP transaction. Let's walk through the specific numeric ledger line by line. Vendor name, ABC Supplies Private Limited. PO number and date, PO 4587 on 2/2 May 2024. GRN 7890 on 5 May 2024. Invoice number and date, INV 2215 on 6 May 2024. The invoice amount is 75,000 rupees. Payment terms are 210, net 30, meaning a 2% discount if paid within 10 days. Payment date and amount made, 15 May 2024 for 73,500 rupees, meaning the discount was availed. And our audit check confirms PO, GRN, and invoice matched, and payment was made within the discount period. We successfully saved the company money by hitting that May 15th window.
But we have to stay vigilant. 8. Common red flags. Watch out for invoices without PO or GRN, duplicate or consecutive invoice numbers, payments made to new or inactive vendors, round figure invoices, payments made before goods received, missing approvals, large number of old pending invoices, and credit notes not recorded. Let me tell you, if you see round figure invoices, like exactly $50,000 instead of $50,214, or consecutive invoice numbers from the same vendor, those are screaming warning signs for fraud. You've got to dig into those immediately.
Okay, we're at our final wrap-up section. 9. Impact of effective AP audit. And 10. Key takeaway.
9. Impact of effective AP audit. What happens when we do this right? It ensures accurate financial reporting, avoids penalties and interest, optimizes cash outflow and cash flow, prevents fraud and losses, strengthens vendor relationships, and ensures compliance with policies and contracts. This list right here is the massive organizational value a strong internal auditor brings to the table every single day. And here is the complete accounts payable audit mind map from our source material. Take a second to celebrate how we've systematically unpacked this dense, highly structured diagram together, piece by piece.
Which brings us to 10. Key takeaway. I want you to remember this quote as the ultimate golden rule of accounts payable auditing. A well-controlled accounts payable process ensures that the right amount is paid to the right vendor at the right time for the right goods/services with proper authorization and documentation.
We'll conclude with this powerful equation from the very bottom of our source framework. Strong AP controls equals accurate liabilities plus timely payments plus cost savings plus compliance plus strong relationships. So I'll leave you with a question to ponder. When you walk into work tomorrow and look at your own organization's AP process, do your controls truly add up to this level of integrity? Thank you so much for joining me on this explainer. Stay curious, stay sharp, and keep auditing.